All right, welcome to this explainer on Titan Machinery's Q1 fiscal 2027 results. Today, we're decoding a really fascinating corporate survival story. We're going to look at exactly how this major equipment dealer is navigating a severe, overarching drought in demand across the global agricultural market. Get ready, because this is honestly a masterclass in controlling what you can when the broader economic weather turns against you.
Before we get into the heavy math, let's just visualize what Titan Machinery actually does. They sell, service, and rent the heavy equipment that literally builds our communities and feeds our populations. We are talking about massive, massive machines. Think about the sheer scale of a $500,000 combine harvester, towering over a field, absolutely loaded with precision technology. They're a leading network of full-service stores offering heavy-hitting brands like Case IH and New Holland. These aren't just impulse buys, you know? These are massive capital investments that keep the agricultural world spinning.
So, that brings us to our primary numerical hook for this quarter, $522.4 million. That figure represents Titan's total Q1 revenue. But the numbers beneath the surface, they tell a wild story. It's a story of incredible internal efficiency during a period of intense external adversity.
Okay, so here is our roadmap for this explainer. First, we'll meet Titan Machinery. Second, we'll look at the agricultural squeeze. Third, we break down the Q1 financial performance. Fourth, we'll do a global segment breakdown. And finally, map out the road ahead. Let's jump right in. Section 1. Meet Titan Machinery. Let's just do a quick overview of their business footprint and establish exactly where they make their money. As you can clearly see here, Titan's business model is heavily, and I mean heavily, reliant on the agriculture sector. It makes up a massive 65% of their entire revenue stream. Construction, Europe, and Australia round out the rest. But make no mistake, that 65% means Titan is essentially tethered to the financial health of the global farmer. If crops fail or if commodity prices drop, Titan feels that pain instantly. Literally, as global agriculture goes, so goes Titan Machinery. Moving right along to Section 2, the agricultural squeeze. Let's unpack the macroeconomic headwinds that are currently battering that core agricultural equipment market. So the central tension squeezing farmer profitability right now is, well, it's a pretty brutal combination. On one side, you've got a low commodity environment, meaning really low market prices for the crops farmers are actually selling to make a living. On the flip side, that's clashing head-on with consistently high prices for the inputs they need just to keep their farms running. We are talking soaring costs for fertilizer, diesel fuel, seed, the whole shebang. Think about it. When a farmer spends an absolute fortune just to get seeds in the ground and keep their tractors running, only to sell their harvest for pennies on the dollar, their wallet shrinks incredibly fast. And when farmers have less cash, yeah, they're going to delay buying that shiny $500,000 tractor. That tension right there is the root cause of the softening equipment demand Titan is facing today.
All right, Section 3, Q1 financial performance. This is where we hit our aha moment. Let's see how this squeeze actually affected the numbers.
You can see the immediate impact of that farmer squeeze right here on the top line. Look at this. Total revenue dropped from $594.3 million in Q1 of last year down to $522.4 million this year. Over $70 million essentially vanished. It is a steep, undeniable drop, and a direct reflection of that softer equipment demand we were just talking about.
But wait, here is the absolutely crucial, fascinating aha point of this whole explainer. It honestly sounds like financial dark magic, but despite revenues falling by tens of millions of dollars, Titan's overall gross profit margin actually increased, up to 17.1% from 15.3% the year prior. Like, how on earth do you make your profit margins go up when your overall sales are going down?
Well, Titan pulled this off by ruthlessly trimming the fat and focusing purely on what they could control. First up, they aggressively reduced their aged equipment inventory, basically intentionally selling off their older, less profitable stock. Second, and this is a real game changer, because fewer new machines were selling, their revenue mix naturally shifted toward parts and service. Makes sense, right? If farmers can't afford to buy new tractors, they are forced to repair their old ones. That creates a highly profitable lifeline for Titan, because selling parts and repair labor inherently yields way higher profit margins than selling whole equipment. And finally, by holding less overall inventory, their floor plan interest expense, which is just the cost of financing all that massive heavy equipment sitting on their lots, drops significantly from $11.1 million down to $8.2 million. Okay, Section 4, Global Segment Breakdown. Let's look at a tale of different regions and drill down geographically across Titan's global footprint.
Looking at this, it is a pretty divided landscape across the globe. We're seeing sharp contractions in core agriculture,
down 10.4%, and construction down 6.5%. And wow, Europe saw a massive 35.6% drop. But quick caveat, context is super important here. Europe's plunge is largely because last year's numbers were artificially inflated by massive European Union stimulus programs in Romania. Once that government cash dried up, demand just snapped right back to reality. On the flip side, though, interestingly, the Australian market bucked the macroeconomic trend entirely. They posted a super solid 14.3% revenue growth, which really just proves that having geographic diversification can occasionally act as an incredible shock absorber.
And finally, Section 5, the road ahead. Let's examine how Titan is navigating these trough conditions for the rest of the fiscal year.
CEO Brian Knutson hit the nail on the head here. He says, in addition to our ongoing inventory optimization initiative, we remain focused on proactively strengthening our core footprint where we are best equipped to deliver long-term returns for our shareholders. To put that into plain, conversational English, the strategy is to aggressively control what you can, like keeping your inventory lean and focusing only on your absolute strongest markets, while you patiently wait out the external macroeconomic storm. And management absolutely expects that storm to stick around for a bit. Their original equipment manufacturing partners expect these trough-like, bottom-of-the-cycle conditions to last through calendar 2026. Keep in mind, this is a highly cyclical industry, and right now, they are fully in the valley. Because of this, Titan projects their core agriculture segment will remain down 15 to 20% for the year. To protect their core operations, they're actually actively winding down their German business in Europe right now. Strategically, it makes perfect sense, right? Cut your losses in a struggling, non-core region so you can lean heavily on the strength in the expected 10 to 15% growth of your booming Australian segment.
So, that leaves us with this final thought. We've seen how Titan is proactively clearing out old inventory, shifting their focus to high-margin parts and service, and significantly slashing their interest expenses. Here is the million-dollar question. If Titan Machinery can successfully harvest this kind of sharp operational efficiency during a harsh drought in demand, are they setting themselves up for massive amplified profitability when the agricultural cycle inevitably turns and farmers start buying again? It's a truly fascinating strategic play and one we are definitely going to be watching closely. Thanks so much for joining me for this explainer.